The majors trade sideways after a new health care proposal and ahead of a very likely rate hike. Joining me to talk about all this biz is Sarge Guilfoyle, rain or shine, or a little in between. Thanks for joining me, Sarge.
We are a little in between. This is the market, and I'm glad to be here. Thanks.
Yeah, well said. Well, yesterday we were finally presented with a new health care proposal. Now, looking through those 66 pages, what do you think investors liked or disliked?
You know, it's hard to say right now because we don't even have a score yet as far as what the costs are going to be, how many people are probably going to fall off the low end of the rolls. But there are positives. It spreads out the cost among far greater people, therefore lowering the cost on small business owners and on the middle class. That's a positive. But there's going to be a long road to hoe here, and there's going to be some fighting within Congress. A lot of the guys, the more conservative congressmen and congresswomen, probably aren't going to like this because it's probably a little too liberal for them. There is still, with these tax credits instead of the subsidies, there is still a sizable chunk that people will be able to appropriate that will come off their taxes, thus lowering tax revenue. There's also a lot of the Obamacare tax-related taxes that won't be in the plan as it evolves. We don't really know what the plan will look like when it's passed. We just know that it's going to take a month or so, if we're lucky, to pass it, and this is part of the larger budget. So we need the budget to pass before we can get anywhere near tax reform, which is where us traders really want to go.
Now, Sarge, it has been suggested if we don't have concrete action on healthcare, on tax reform, we're not talking about a correction. We might see a crash mid-year. Do you foresee that?
No, not yet. I do believe that as long as the market believes, as long as people believe that these reforms are still in our future, you can push it out. If things get delayed, but we still believe we're going to see tax reform, a nicer regulatory environment, repatriation, things of this matter, then we'll push out the bull. The bull will go on into 2018 if it has to. Only when the market stops believing, if traders stop believing, if you see all those confidence measures come in a bit, then you might see your crash. You are going to have to protect yourself along the way, and you're going to have to use your risk management skills. But no, I don't see a crash in our immediate future.
Okay, well that's good news to many people. Now the S&P has already hit its end-year target in just 7 weeks now. So what levels are you watching? What stocks are you watching? ETFs? That seems to be a new picture people are pouring their money into recently.
Well, yeah, ETFs are attracting a great deal of the investor money these days because it's a lot easier than actually picking stocks. Do you like healthcare? Go to healthcare. Do you like the financials? Go to the financials without really cherry-picking the banks or consumer finance or the stocks themselves. I do believe that you do want to pick stocks. I personally don't like ETFs. I like to be my own ETF. I like to be long individual banks when I like the banking sector, which I do now because I'm still on the trajectory of future growth. When I have taken some profits, but at some point, if I stop believing, then I will take the rest of those profits. Hopefully there's still profits at the time, and I'll take them off the table.
Well, in the meantime, we're also eyeing the Fed, and they look like they're totally going to raise rates next week. But it's not all about next week, is it, Sarge?
Oh, not at all. I mean, it is to some degree. We do expect to see that quarter-point rate hike from the Fed next week, even though Q1 GDP is now tracking around 1.3%. Now, how much latitude does that give President Trump? I mean, he's off the hook now. If something ends terrible and they go ahead and raise the Fed funds rate with a GDP that's barely positive, well, he can blame someone, can't he? So if they go ahead with this hike and they all seem like their ducks are lined up in a row, and a lot of the macro is better, regardless of this weaker GDP number, well, then he's going to be able to do what he needs to do and blame someone else, which is probably going to work out for his team.
Well, the only other thing that can really stir up the convo is if we get a really bad read this Friday. Now, for the jobs number. Now, do you like to look at the headline number? Do you like to look at the U6, the Gallup? What do you think gives a really good understanding of the employment situation?
I look at them all, but I think the underemployment rate is the most important rate. The U6, as far as the BLS is concerned, and the Gallup runs a number also, which is usually 4 to 5% higher than the BLS number, because let's face it, Gallup is a corporation. It's a little more efficient than the BLS is, and it's also not a true apples to apples comparison. It's not seasonally adjusted. It's more of a raw number, and it's tabulated differently. But wage growth is going to be the most important thing. And for me, participation rate and that U6 number will also be very important.
All right. Well, whether you U3 or U6, you know Stephen Guilfoyle always gives the best analysis. Thank you so much for meeting with me today, Sarge.
Thank you very much, Olivia.